Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. I followed his work for years. I think he does a really good job changing his opinion when the facts change. He's an investment advisor representative at Sitka Pacific Capital Management, and he also runs one of the most popular financial blogs on the internet, Mish's Global Economic Trend Analysis. Michael Mish Shedlock, thank you for joining us on a podcast.
Hey, Jason. It's a pleasure to be on the show.
Yeah, I'm really excited to talk to you, Mish. I really enjoy your interviews and your articles. I think you provide a very interesting take on things here between some of the blind ideologues that we tend to run into on the markets, either the hardcore Keynesians like Krugman or other people who are hyperinflationists. And that leads us into who are hardcore hyperinflationists no matter what. So that leads us into my first question. We have a lot of people that are still calling for hyperinflation in the near term. I think John Williams of Shadow Stats, while his analysis that there may be 8% inflation in the economy right now may be accurate, his inflation timeline of, I think, hyperinflation in 2014, 2015 has been totally off. Why hasn't hyperinflation occurred then in the United States and in the U.S. dollar?
I don't even think it's close. I don't think it's going to ever happen. Of course, we have to define what we mean by ever. But I said in something like 2004, actually, that I thought there was a strong chance, when everyone was gung-ho on the end, I thought there was a strong chance that we would see it in Japan first. And now, interestingly, people are coming around to that exact viewpoint. But hyperinflation is a complete collapse of a currency. The idea that the U.S. dollar was going to go to zero overlooked so many things, that they all overlooked so many things. First off, China was printing money, and money supply growth in China was going way faster than the U.S. If you look at the problems of European banks, European banks are in actually worse shape than U.S. banks. European demographics are worse than U.S. demographics. The UK is a veritable basket case in and of itself. Its trade is worse than the United States. All of these factors I just looked at and said, how is the U.S. dollar going to go to zero versus all of these other flawed fiat currencies? I just didn't see it. And at a time when...
Okay, so you're talking about the other flawed currencies, Mish, and it just seems that there's a race to debase. The global financial system. I think a lot of people don't understand. We're on a dollar standard, I guess, right now, and the policy goal for many years has been to prop up the dollar, to prop up the U.S. bond market and treasury market, to give the U.S. consumer more purchasing power, so they can buy cheap Chinese goods or something like that. Is that part of why we haven't seen hyperinflation?
Well, there's two parts of this thesis. Everyone says, well, look at what's going to happen. Just wait until China dumps U.S. treasuries. It's not going to happen. China is taking U.S. dollars. They're converting those into yuan. Money supply growth in China has been soaring as a result. And it's still one of the top ones in the world here in terms of credit growth and credit expansion. So the idea, and China's doing this, they've suppressed the yuan in order to boost their exports. So this idea that all of a sudden they're going to go around selling U.S. treasuries when they're buying them on purpose is just fatally flawed. Every central bank on the planet is out to trash their currency. We have competitive currency debasement. We see it now in the euro. We see it certainly in Japan. We see it in China. We see it in the UK. Look at interest rates globally. Look at what Australia's doing. So all of these things are all tied together. The idea that the U.S. dollar is going to go to zero when every country on the planet is doing the same thing is just fatally flawed. People don't even understand the origin of hyperinflation. It's actually not monetary. It's political. If you look at the hyperinflations in history, look at German Weimar. Hyperinflation was a result of political war reparations imposed by the U.S. and by the U.K. and by the rest of Europe on Germany at gunpoint. In Argentina, we saw hyperinflation when they tried to peg unwisely the Argentinian peso to the U.S. dollar. In one of the biggest ones in Zimbabwe, we had policy changes by the regimes over there that caused capital flight and monetary flight. The origins of these are political. It's the political mistakes that have happened first that led to the monetary inflation happening second. We're seeing that now in Venezuela. It's really a political crisis over there, much more so than a currency crisis. And looking at it from that regard, well, the U.S. has been pretty stable. So those calling for hyperinflation, are asking for this geopolitical event that I don't think is going to happen. Bernanke would step in a second to prevent hyperinflation if it came to that. What could cause it in the United States would be a political event. Let's say Congress decided that we're going to give everyone in the country $100,000 a year indexed to inflation. Would that cause hyperinflation? You bet it would. But that's what it would take. It would take Congress doing something. Central bank is not going to cause inflation. I said that QE would never cause it. It didn't. It won't. It won't in Europe. It's other actions in these countries. It's political actions, not currency actions that lead to hyperinflation. That's what they've all missed.
Now, Switzerland has also printed a lot of money. They've pegged to the euro. And another point you could add why the U.S. might not get hyperinflation is a world reserve currency has never hyperinflated before. So, yes, the British Empire did have really bad inflation, I think, when they were printing too much money after World War I, and I believe also after World War II, up until George Soros broke the pound in quotes. I mean, the pound was going to break on its own. But anyway, though, there just hasn't been any historical examples before of a world reserve currency hyperinflating. Now, also to maybe counterpoint that, we also haven't been on a global fiat currency experiment where every single currency has been unbacked on fiat currency before, right, in the world.
That's exactly right. And, it's a case of relativeness, actually. Yeah, you might not happen to like the U.S. dollar. Actually, I've been on the right side of the dollar trade more often than not. My position on the dollar has fluctuated over the years. When everyone, all the hyperinflationists, were calling for the dollar to crash, I said, my gosh, look at this. The U.S. dollar is fallen from 120, the U.S. dollar index from 120 all the way down to 70, and they're still calling for a crash. I looked at it and I said, you know what? Seems to me the U.S. dollar on a relative basis is undervalued. And that's what we're talking about here. Now that the U.S. dollar index is flirting around 90, and everyone thinks that the Fed is about to embark on this massive hiking, or even just hiking at all, actually. Doesn't have to be massive. I'm taking the other side of the coin. I'm now saying, you know what, I think the dollar's a little bit overvalued here. So that's how you have to look at these things. And you stand back, and all the people that have called for U.S. hyperinflation, and some of the forecasts were funny. I've debated several people that thought that it was going to happen by 2012, then it was 2013, then it's 2014. I'm not sure, not to pick on Williams, I'm not sure what his target for that is now, but these guys just don't get it. They are only looking at what the Fed is doing, what the U.S. is doing. They're not looking outside the U.S. to see that all the other central banks are doing essentially the same thing.
Yeah, that's a good point. And what these other central banks have done is I think they've essentially propped up the dollar because, you have these other countries, their currencies are under attack. The Russian ruble has fallen so much. It's under attack, either financial warfare or it's just a combination of drop in the oil price or financial warfare from Wall Street and the U.S. government who don't like Putin. And then you have these developing countries who owe a lot of debt now in U.S. dollar denominated debt, and you have countries like India where the Indian rupee has fallen a lot, but then yet they owe a lot of debt in dollars. So it's a really interesting scenario, Mish, where all these countries like China, like you mentioned, Japan, they've all printed enormous amounts of money. It's some of it's gone into the real economy, but not a massive amount, not enough clearly to create hyperinflation. But a lot of that money has gone into the asset markets all over the globe.
Oh, absolutely, and that gets down now to a definition of inflation, and this is where I think all of the Paul Krugmans have got it wrong. They look and they say, there's no inflation, and certainly if you look at the CPI, there's no inflation here. There's actually deflation in Europe if one looks at the CPI. But that's a faulty way of looking at things. My definition is a little bit different than most people. Certainly I don't look at prices. I think inflation is about money supply and credit. An increase in money supply and credit, I think mark to market. So how are the banks doing? What are the balance sheets on the books of banks look like? And that's where Europe is probably in outright deflation right now, not just from a prices are falling standpoint. It's really a minuscule amount right now. But Spain's about 0.5% negative or so. Germany is just very slightly positive. But if you look at how leveraged the European banks are to the sovereign debts of Spain, of Portugal, of Italy, each of these countries' banks are leveraged to their own sovereign debt, and these things are trading at yields as if there can possibly be no default. Well, you know what? The banks aren't lending and won't lend, even though Mario Draghi's trying to spur lending, because these banks are capital impaired. You can do all the surveys you want in the world that say, that these leverages are okay, and the ECB does these stress tests all the time that say our banks aren't impaired. But if you look at bank actions, those actions are rather telling. Banks aren't lending because they're capital impaired, or there are no creditworthy borrowers that want to borrow cash in Europe. That's why they're not lending, period. And lowering interest rates does nothing to solve that problem. That is the problem in Europe. And for all these Krugmans to come by and say, well, there's no inflation. Well, of course there's inflation. It's just manifested itself in asset prices, not in consumer prices. We've got a bubble in junk bonds right now that's going to burst. We've got arguably another bubble in housing, although it's not as bad as it was the first time. We certainly have a massive bubble in equities globally, but especially the U.S. The U.S. stock market is as overvalued now, or is more overvalued now than any other time in history, except for 1929 and the dot-com tech wreck in 2000. So these bubbles, actually bubbles by definition, burst. And when they do, they're going to bring upon the very asset deflation that's destructive. So all these moves by these central banks are counterproductive. They're bringing upon the very destructive deflation that they want to avoid. Falling consumer prices has never hurt anyone. It's never hurt any bank. Asset prices, when banks have made loans on assets, will cripple the economy just like it did in 2007, 2008, early 2009. I think we're headed for another round of that, and that that is the destructive deflation. And I think, Jason, we're in for another round of it.
Yeah, the Keynesians definitely don't count asset price inflation as inflation. I've gone back, through decades of financial history, and they've been trying to inflate asset bubbles. They think that's good for the economy, and that capitalism on its own, free markets, naturally create enormous asset bubbles. So they think the central bank either creating a new bubble doesn't do any additional harm to the economy. I think that's their ideology, where they come from. But you mentioned lowering interest rates and trying to spur either consumer demand or business loans, but I think they're also lowering interest rates, Mish, due to financial repression. So we've seen enormous amounts of financial repression in Japan, in the United States, in the UK, in Europe, where these lowered interest rates are lowered so the governments can continue borrowing. The debt to GDP ratio, in my opinion, really doesn't matter. I think that math people have missed. I think that's the wrong math equation. I think the math equation that people need to pay attention to is what Kyle Bass brings up, how it's all about paying the interest payments on the debt. So the debt itself doesn't really matter. It's just about being able to pay the interest payments with your tax revenues. So that's what it seems to me is the game plan is to lower the interest rates for the governments to continue borrowing at lower and lower interest rates so they don't have to, massive cutbacks and full austerity programs. And then also for these banks and hedge funds and stuff like that to do crazy amounts of, carry trades and leverage speculations, put one currency into a foreign bond market or things like that.
I would tend to agree with both those points. But first off, let's go back. What is financial repression? I define that as a series of fiscal and monetary policies for the express benefit of the ruling class, the politicians, the banks, the already wealthy, at the expense of everyone else. And certainly, if you look at who benefits from inflation, it's not the average guy on the street because wages have not kept up. The inflation benefits those with first access to money. Who is that? Well, obviously, it's the banks. It's also the government via taxation. When the value of your house goes up, so does your property tax. And so government takes that money and sloshes it around to all of their political cronies. And so it's the politicians also. And the
same with stock portfolio too. Yeah, capital gains.
Yes, yes. It also benefits the wealthy in that the wealthy are the ones that own stocks, and stocks are the ones that generally go up the most. And bonds, look at the price of the bonds. How can one believe that there's not a bond bubble when sovereign debt in Italy, in Spain is trading at lower yields than it is here in the United States? It's pricing in 0% chance of risk of Spain leaving the Eurozone, of Italy leaving in the Eurozone, of Greece leaving the actually Greece now, the interest rates there are soaring because of that renewed fear. But until recently, even yields in Greece had plunged to amazingly low levels for a country that is where politicians in Greece are making express threats to leave the Eurozone. So all of this, when central banks step in to repress these interest rates, they create these bond bubbles, and we are in an enormous one now. In the U.S., it's not a bond bubble in sovereign debt like it is in Europe. In the U.S., it's a bubble in junk bonds. So, and I think we're going to see a spillover sometime. The junk bonds of energy corporations have really taken a hammer lately. Some of these things are down, 40% just since September. It's a massive move in junk bonds. These things that were yielding, 7 or 8% are now yielding 27%. And that's reflective of all of this malinvestment that went flowing into drillers on the presumption that oil prices would keep rising forever. And once those prices started to came back, now, as the other point you've mentioned, is people are starting to question whether or not the interest can be paid back. And that's what's going on in Japan right now. people are questioning whether or not interest can ever be paid back. A rise in Japan of a mere 2% in interest rates from zero where they're held now would consume 100% of all Japan's tax revenue. Is that a sustainable situation? I don't think so. But so what does Japan have to do about it? They're going to have to hold interest rates low even if inflation ticks up massively. How is that going to work? Well, that's going to work with a big capital flight out of the yen, and I think we're seeing the start of that now. And these things can get out of hand, and this is a political mistake that Japan has made of its own accord, and keeping on the same path as Abenomics wants to do it. You know, there's your trigger for a political mistake that could lead potentially to hyperinflation in Japan. And people thought I was nuts in 2004, 2005 when I said that Japan would see it first. Well, I didn't. Doesn't look so nuts now, does it, Jason?
Yeah, and I think we could see the yen over 200 to the dollar again in less than a decade. The way things are going, I don't know about you, Mish, but I could talk about Japan for a long time. We have some time constraints in this podcast. I want to get to other topics, but I don't see any way mathematically that Japan can keep the game going any longer without monetizing more debt, printing more yen to buy up their own bonds.
Well, they're already doing it. They are over 100%. The Bank of Japan is buying over 100% of debt issuance in Japan every month. Over 100%. Now, what's that say? That says that they're sellers bonds, right? Of Japanese bonds, and the Bank of Japan is the buyer of only resort.
Yeah, and I think to add to your points there about the different asset prices going up, I think it's an enormous red flag when stock prices, bond prices, real estate prices, all these things are rising at once. As you know, you're a stockbroker, investment advisor, represent. One of the main things you're taught when you're taking tests and learning about finance and economics is that there's supposed to be non-correlation in assets. So when one asset market goes up, another one's supposed to go down. We're not really seeing that happening right now in the markets because the money printing distortions from all these global central banks are distorting the normal correlations in asset prices.
Precisely.
Now, Mish, I want to move on to another topic that you're passionate about, that you write a lot about, and that's about technology. We seem to have a lot of technology, a lot of innovation that's coming down the pipe, either now or in the next 5 or 10 years. Do you think that's going to be offsetting a lot of the inflation that people have been anticipating?
I think it already has. It's suppressed jobs. It's suppressed the value of jobs. Certainly, if you've got a top technology spot or you're an engineer, especially at least for a while there, an oil engineer of some kind, that you've done pretty well. But we've seen a lot of jobs at Amazon, even in the fast food industry, at Walmart, at various places, just give way to the use of robots. And this is why rising, all of this talk about, minimum wage and a living minimum wage is the wrong focus. Actually, wages aren't living now. We don't have living wages, and we can actually blame the Fed for this. Instead, people are blaming corporations. Well, if you raise the minimum wage to $15 an hour and it's no longer profitable to hire someone at $15 an hour, what are you going to do? You're either not going to hire that person, you're going to go broke if you hire them and have to pay that wage, you're going to go out of business, or you're going to turn to robots. So when the Fed is holding interest rates as low as it has, corporations have been able to borrow money at ridiculously low rates. And what are they doing? They're investing in technologies so that they have to hire few workers. So a lot of it ties back into the Fed. But this is the ongoing scheme anyway. It's the Fed and central bankers trying to force up wage inflation, though, that have exacerbated this problem. Now, over the long haul, I believe that technology creates jobs, but right now I think we're in a creative destruction period, unlike, say, in contrast to, what went on to the mid to the late 90s, where computer technologies came out and everyone was buying computers and then upgrading computers and putting in fiber lines and upgrading computers again because they weren't fast enough, upgrading software because there's new software. Well, now we're pretty much saturated with that. Any computer that you have, it performs all the tasks you need. And now computers and technologies and robots are actually, for the time being, destroying more jobs than they create. I think that that's a technology pendulum that swings from one direction to the other, but the Fed's policies have made this current swing worse than it is.
Yeah, I just read a book called The Second Machine Age. I don't know if you've read it or heard about it, but it talks about some of the future of robotics and software programs and algorithms and artificial intelligence. And it seems to think that, robots are going to replace taxi cab drivers and truck drivers and, some of these lower paying jobs that, how there's just so many car accidents on the road and that, yes, the Google self-driving car, it might not be able to drive at a top speed or something like that, but it's going to create a lot less accidents and save a lot of human lives. But in the short term, it's going to destroy a lot of jobs. In the long term, it's going to make society more productive, and maybe it'll free up those people who are taxi drivers. It'll give them more time to go and learn a much higher paying job where they can make a much higher salary and do better for themselves and their families in the long term.
Well, what it should do and could do in absence of government intervention is drive down the cost of services. In France, they just banned the Uber, and I think they're considering it in Spain, and the companies had some problems even here in the United States. But what's wrong with the concept? And they say, oh, well, they're not regulated, people might get hurt. You know what? Let people decide for themselves. If this company goes out and hires, a bunch of criminals and people start getting hurt, they won't use the service. And the other thing is, you can say just impose. I'm not a fan of regulation, but it's kind of hypocritical to say, well, we're going to shut down this taxi company because it doesn't have insurance. Well, you can always require it to have insurance, can't you?
Uber didn't have insurance initially, right? And then they added it pretty quickly, right? Because there was customer backlash, right?
Mm-hmm. The cities don't want it. They want their medallion service. It costs something like in Chicago. I'm going to make up a number here, but I think it's something along the lines of what I heard, over $100,000 for to get a taxi license. That's what they're trying to preserve. Where's and the only way the taxis can make any money, paying that kind of rate for their medallion license is to charge high fees. So along comes Uber and says, you know what? We can transport someone, from the airport to downtown for, I don't know, a couple bucks instead of $15 or $40. The consumer would benefit from that. The only person that doesn't benefit is the government, because they want to collect their freaking $100,000 for that taxi medallion license. So the falling prices would benefit people if the government would just step back. And they say that businesses will go out of business. If prices fall. Well, not if input prices fall. So if the price of cotton falls because of productivity, if the price of metals falls because of productivity, if the price of goods and services fall because a robot is producing this rather than a human, guess what? The standard of living actually goes up. More people can afford these goods and services. People today live like kings compared to people even 100 years ago, and falling technology prices, the one place where government has tended not to intervene, is a big part of that.
I completely agree with basically everything you just said. I mean, the Keynesians don't understand the relationship between wages and prices. When wages don't go up, prices have to be allowed to fall. We saw this screw up, what the Keynesians did during the Great Depression in 1929 with Smoot-Hawley, where they wouldn't let, if I want to go back through financial history, and they wouldn't let, the farm prices fall, but people they couldn't get jobs. They were burning through their savings. They couldn't have any wage increases, but yet the Keynesians back then, through all these rules and regulations and tariffs and things, they wouldn't let the prices of food fall.
Roosevelt burned crops, actually confiscated. The man should have been put in prison. Instead, he's revered as a hero. Roosevelt confiscated farmers' crops and burned them, hoping to get the price of crops to go up. Well,
instead of feeding
he deprived these people of their money so they couldn't buy anything, exasperating the problem, creating the very problem he was trying to prevent.
I agree. Well, there's a problem with Keynesian economics and central planning.
Absolutely.
It doesn't judge itself in the real world, and when it does have bad results, they blame it on capitalism or the free markets or some other excuse, or they hire a couple dozen PhD economists at the Federal Reserve or in academia, and they give them $100,000 grants, like what we found out in Inside Job. To they have their idea of a conclusion, and then they just fill in the facts later with bad science to prove it, with bad research.
Absolutely. And Krugman right now is revered, yet he's the one that's been encouraging Japan to go down the very path that Japan's gone down, and Japan is going to blow up. And is Krugman ever going to admit that he was wrong about it? Never. Not a chance.
Didn't Krugman also encourage the housing bubble too? Didn't he wanted, when the technology bubble wrecked, didn't he say to lower interest rates, for the Fed to lower interest rates and start fueling a housing bubble too?
Actually, he said is what we need is a housing bubble to get us out of this. Now, his later claim was that he was saying that just in jest. But if you look at statements at the time, they sure sounded genuine.
Yeah, I think he's being genuine, and I think Janet Yellen is a hardcore Keynesian too. I think all of them are. The only one who I think wasn't a hardcore Keynesian was Alan Greenspan, but I consider him more of a sellout because, he knew better after being like an Ayn Rand follower and reading Austrian School Economics and understanding, gold and economic freedom, writing that great paper on it.
He's a sad case, that's for sure.
Now, Mish, my final question here for this interview has to do with value in the stock market. We've seen the gold and silver stock. I know you like the gold and silver stocks, at least in the past. We've seen them knocked down in a cyclical bear market the last 3 years. It's been very rough. We've seen the oil prices drop, I think, more than 40%. Some oil companies are down, I think, more than 40%. Now, it seems to me that the baby has been thrown out with the bathwater for some of these companies, that the market hasn't really discriminated between a good gold company and a bad one, a good silver company and a bad one, a good oil company and a bad one, that basically anything with oil in its name or gold and silver in its name the last 3 years has basically just been indiscriminately sold. Is that where you see value in the market, or do you see value in the market somewhere else?
No, I see value in the market in several places. I like gold and silver right now more than energy. I'm not sure that energy has fully played out yet. One of my favorite trades right now, it's actually doing pretty well, is a yen hedged position in Japanese equities. I happen to like Japan. I think their equities are undervalued. Deflation has wrung out all of the debt in Japan, but so these companies there are pretty good, except you have to worry about the falling yen. So the way you protect yourself in that trade is to buy the Japanese equities and to go out and put a yen hedge on it. There are ETFs that actually do that in one trade. I don't have the symbol here off the top of my head, but there's several of them. You can go out and do that all in one trade if you like. I like the miners here at this point. I think they are priced as if gold and silver are going to completely collapse from here. But gold and silver have already collapsed. Silver's down from 46. It hit a low of 14 a couple of weeks ago. So, can it drop to 12? Sure. Can it drop to 10? Yeah. Will it stay there? I don't think so. So I like that. One can make the same claim about oil. it can drop further, but it might not stay there. But in light of what central banks are doing across the board, I think that when if the Fed doesn't do these rate hikes that everyone has priced in, we're going to see a strong reversal in the U.S. dollar, and that's going to do wonders, especially for gold, probably for silver. I don't know so much about copper. Copper is an industrial commodity, and I think the investment boom in China is over. So I would be leery of industrial commodities because I think China is in the process of rebalancing. That's going to go on for a while yet, and so I would stay away from industrial metals.
Very good. Yeah, I agree with you on industrial metals. So your steel, your copper, your iron ore. There's zinc, which has some supply shortages, but other than that, like almost all the regular industrial metals, they've just been in oversupply, and I think the demand has been artificial. Like you said, there's just been so many centrally planned projects. I don't think the demand is real in China for that much copper or that many buildings or houses. I think they're having some problems selling them if they keep building them.
Yeah, China's overbuilt, and everyone got on this theme of China. Actually, it's going to be the consumer market in China. Consumer goods, consumer brands is probably actually going to be very deflationary when China comes out with its own brands, say, to compete against something like
Johnson & Johnson.
Yes,
or
exactly,
Coca-Cola.
exactly. That's the right idea.
Yeah, and Chinese car sales are actually still increasing pretty strong, and unlike the U.S., where people are getting like no money down subprime car loans here, and their cars are probably going to get repossessed in the next couple years, people in China have had to save up for many years. A whole family's had to save up to all chip in and pay for their car, and I think over the long term, I think oil and gasoline usage in China is going to increase, and we've seen that in the numbers, I think, now that China is the #1 world consumer of energy, I think.
Absolutely. So we've got all of these global imbalances here that we're talking about, and in interest rates, in currencies, in energy. We've got a huge slowdown in Europe. We've got a huge slowdown in China. This idea that it's a reverse decoupling thesis, Jason. Remember, back in 2008, so many people were talking about decoupling and how China was going to decouple from the U.S. market. Now we've gone full 180 degrees. I didn't believe it back then, but now people are saying, well, the U.S. is going to decouple from the rest of the world. It's going to decouple from Europe. I didn't buy the decoupling theory in 2008, Jason. I don't buy the decoupling theory now.
Yeah, I think the whole global economy is connected. I agree. What the people who said China was going to decouple, what they didn't understand is that, China, Japan, Brazil, Russia, so many of these other developing countries, although Japan's not really developing, but they were still using these Keynesian mercantilist type of economic models where, they were still relying on exports. They didn't have a balanced economy and things like that. So, the game for the centrally planned economies is to boost your exports, devalue your currency, and every country has been trying to do this playbook, including the U.S. at some point, through these, Keynesian central bankers. It's just all ridiculous to me.
Absolutely, Jason.
Well, Mish, I just want to thank you for your time. I really enjoyed this discussion. Hopefully we can do it again soon. You brought up how we can maybe do this once a month or something like that. We can talk about the markets if you want.
Very good. I'm all game for it. It's a pleasure to be on the show, Jason.
Okay, now, Mish, before we let you go, please tell our listeners where they can find your work for our listeners who are already not familiar.
I'll give you the long way and the short way. My blog is globaleconomicanalysis.blogspot.com, but no one will ever remember that or type it down correctly. The easy way to find me is just do a Google search for Mish, M-I-S-H. It's just the first two characters of my first and last name, Mike Shedlock. So do a Google search for Mish. I write about the stock market, the economy, interest rates, gold, typically 3 to 4 times every day and a couple of times even on weekends. So do a Google search for Mish and check me out.
Okay, great. Well, thank you for your time, and I enjoyed this discussion, and hopefully we can have you back on again soon.
My pleasure, Jason.